Hello, and welcome to a brand new Fintech Takes sponsored podcast miniseries. We haven't done one of these in a little while, so just to refresh your memory, every once in a while we come across a great company who has a great idea for a very detailed, deep dive topic that we think is best to explore in the form of a series of podcast episodes. So I am delighted to introduce this new series that we're doing. Title for the series is Model Citizens. AI compliance for banks and fintech lenders. This series is sponsored by my friends at FairPlay, a company that I have long admired and leaned on to get smarter as it relates to really the collision of lending, compliance, AI, fairness. This is, I think, a growing area of interest. It's a growing area of challenges as we sort of rush into this future of AI. So I could not be more delighted to bring this series to life. And to help me do that is the founder and CEO of FairPlay, Kareem Saleh. Kareem, thank you so much for hopping on.
Thanks for having me, Alex. We're delighted to be partnering with you on this.
This is going to be a lot of fun. We have sketched out a series of 6 episodes where we are going to explore every aspect of AI compliance for banks and fintech lenders. We're going to touch on a whole bunch of different areas, really spanning the gamut from the changing compliance landscape with everything happening at the CFPB to credit risk and the intersection of credit risk and AI and compliance to just what it's like to be a compliance officer in the age of generative AI, which is a pretty wild experience from what I gather and something I'm really looking forward to digging into. So a lot of different areas. Just to give a sense for listeners on the context for this series and why we're doing this, I'm wondering, Kareem, if maybe you can give us a little bit of your background personally, as well as kind of, for those who don't know, what FairPlay does and why you were interested in partnering together to bring this series to life.
Sure. Well, I'm the founder and CEO of FairPlay. We are the AI enablement company for the financial industry. We help financial services companies build, test, optimize, and validate their AI systems. Some of the most prestigious financial institutions in the world use our software to identify and correct blind spots in their AI models. This is especially important as more and more lenders adopt advanced predictive models, adopt generative AI systems, adopt AI agents. You want to make sure that these systems don't either pose a threat to the safety and soundness of your institution or to the consumers you serve. Mm-hmm. In addition, these questions are sort of more important than ever now because we live in a choppy macroeconomic environment. There's lingering effects of inflation. There's tariffs. There's a whole set of new regulatory and budgetary changes arising from Washington, D.C. And that means that lenders are going to be called upon more than ever to adjust their underwriting techniques, experiment with new data sources, maybe adjust their approval and denying thresholds and their marketing strategies. Mm-hmm. And AI is going to be woven through all of that. And so our aim is to help financial institutions get the ROI of their AI investments by helping them get their AI models into production quickly and to make sure that those AI models don't pose a threat either to their firms or to their consumers.
No, it's really just so topical, as you're saying, because I think when I think about this space and the conversations that we're going to have over the next 6 episodes, it's really a confluence of all those different factors you mentioned, right? Obviously, and we've talked about this, we'll talk about this in multiple episodes, AI infuses everything that we do in financial services, right? It is the literal water that we swim through every single day. And it has been for decades. But as with any technology, the pace of change and the potential benefits and the potential risks compound faster and faster, it feels like, every single year, every single month, every single week, every single day. I don't know about you, Kareem, but I have a really hard time just keeping up with everything coming out of the world of AI right now. It's incredibly fast-paced. And at the same time that that's happening, as you said, this is happening over a sort of macroeconomic environment where I don't remember in my career studying this space that I've seen it as uncertain as it is right now, right? There's just no sense, I don't think, of where the economy is going, what's happening with consumers, how lenders are going to react to that. And then you overlay on top of that economic uncertainty regulatory uncertainty, right? And this is going to be a theme across all the episodes where we talk to folks. Anytime you're talking about compliance in the US, you are talking about an environment where the politics behind policymaking swing rapidly every 4 years, seemingly. You're talking about an environment in which you have both federal regulators and state regulators all sort of jockeying for different roles at different times. And it creates, again, I think this key word for this series is uncertainty. And how do you navigate that uncertainty? And I mean, it sounds like that's what you guys help clients with and talk to clients about every day, right? Is this uncertainty?
Yeah, that's right. These AI systems have tremendous potential to do good across the financial services industries, good for the companies that use the AI systems and for the consumers that they serve. But there are so many moving parts, as you point out, macroeconomically, regulatorily, and then the systems themselves are prone to things like bias and instability in the face of data that they've never seen before. And so getting that, orchestrating the use of these AI systems in a way that is maximally effective for your business, delivering value to consumers, and that won't get you written up by the regulators, whether it's states or community groups or private plaintiffs' attorneys. Lenders have to navigate a really sticky wicket, and so one of the things that I'm most excited about in this series is the ability for us to kind of invite, call it 20 of our best and most trusted friends and thought leaders who are grappling with these issues at some of the most prestigious financial institutions in America to talk through how they're thinking about the use of AI across their customer journey, from marketing to fraud detection to identity verification to underwriting and pricing and line assignment, and heaven forbid, collections, loss mitigation, claims administration, et cetera.
Mm-hmm. No, you're exactly right. And I think that's a good place to leave this introduction for the series, because really, I think the value listeners are going to get out of this, and why I'm so excited everyone is here listening to this first episode, is the quality of the guests that are a part of this project really has gotten me super excited. It's a mix of old friends and new. So some you actually will have heard on the Fintech Takes podcast before. A lot of folks are new. A lot of folks who actually I hadn't gotten a chance to meet yet. And we're going to have some really great conversations about all of the topics that Kareem just went through. Our hope is that this starts a larger conversation in the industry. As you said, obviously, there's lots of products that are being built in this area. FairPlay has some great stuff that will be referenced, I think, by folks as we talk through some of the challenges in this space. But even beyond the specific products or technology, I think this is just a moment for everyone to kind of come together and talk about, how do we want this to work, right? How do we want fairness and safety and soundness and profitability? Like, how are we going to navigate towards those things in an era of great uncertainty and great potential with these new AI tools? So that's the theme of our series, Model Citizens, AI Compliance for Banks and Fintech Lenders. And Kareem is going to be joining me as a co-host, helping to interview our great guests over the next 6 episodes, starting with this one today. So Kareem, thank you so much for collaborating with me on this project, and I'll talk to you soon.
Thanks, Alex. I'm looking forward to an exciting set of dialogues.
Okay, so this is episode 1 in our Model Citizens miniseries. For our first episode, we wanted to level set on the regulatory landscape because, as you might have noticed, some stuff has been changing. Perhaps nowhere has that change been more evident than at the CFPB, which has been significantly weakened by the current Trump administration in staffing, in budgeting, and quite honestly, just in ambition. What do these changes mean for the industry? Is there an opportunity to move faster and break more stuff now that we don't have a federal consumer protection cop on the beat? Not so fast. In this episode, Kareem and I interviewed David Silberman and Abby Hogan. David was one of the first hires at the CFPB all the way back in 2011 when he was named Associate Director for the Division of Research, Markets, and Regulations. He served at the Bureau until 2020, and he now serves as a Senior Fellow at the Center for Responsible Lending, Senior Advisor to the Financial Health Network, Adjunct Professor at Georgetown's Public Policy School, and an advisor to a number of different organizations. Abby is currently SVP of Legal and Regulatory Affairs at FairPlay. Before that, she worked at the CFPB for more than 9 years in a variety of roles focused on fair lending. And she's worked for a number of financial services companies, including Discover and City National Bank. Abby and David are the perfect people to have in this episode. As you'll hear from our conversation, just because the CFPB is taking a temporary step back does not mean that consumer protection regulation and enforcement is. In fact, it might become even more challenging in the next couple of years. So with that, let's go ahead and jump into episode 1. Okay, well, David, Abby, thank you both so much for joining us. This is going to be a fun conversation.
Thanks for having us, Alex. Looking forward to it.
Yeah, looking forward to it. Thank you.
All right, well, let's dive right in. David, maybe for context setting, I'm gonna direct this first question to you. Can you help us understand how the CFPB has historically worked and sometimes overlapped with state regulators, and what the CFPB is responsible for, what the states are responsible for as it relates to consumer protection, and just like historically, how they've kind of managed that overlap in the past?
Sure, I can try at least. I mean, so I think there's kind of two questions I want to tease, sub-questions there. One is the question of what the role of the states is in consumer financial protection. And then the second is how the states and the CFPB work together. And the truth is, as to the second, Abby may have more insight than I do. That would have occurred mostly on the supervision and enforcement fair lending side. My role at the CFPB was primarily on the regulation, research, market monitoring side. So I have a thimbleful of knowledge there. But Abby may have more to say. But to start with the first question first, so what is the role of the states in consumer protection? I think you have to think about that in two parts. One is, what is their role in enforcing federal consumer financial protection law? To what extent can they be involved in that? And then second, what role do they play with respect to administering, enforcing, developing a separate body or an overlapping body of state law? So to that, really, then if you keep on peeling the onion, the answer is going to depend on the nature of the financial institution you're talking about. So if we're talking about national banks, and I'm using that in its legal sense, not in the sort of sense of banks like Wells and Chase that are everywhere. But for national banks, the truth is the states have very little role because the National Bank Act preempts large areas of any kind of state regulation, either in state application of the state law, and there's not much room for the states to be involved in enforcing federal law even. At the opposite of the end of the spectrum, if you're talking about non-depository institutions, fintechs and the like, the states have pretty much plenary authority to develop their own set of rules and apply their own set of rules, including interest rate regulations if we're talking about lending products, their own UDAP with 1A or 2As if you want to include abusive. States can do as they deem appropriate in terms of deciding what bodies of law to apply. They license these entities to the extent they choose to, have state laws that provide for licensing, regulate, supervise, enforce. And then the Dodd-Frank Act gives states a fairly broad role in enforcing federal law, at least federal UDAP law. There's a legal question as to whether they can enforce Truth in Lending Act, Fair Credit Reporting Act, Fair Debt Collection Practices Act, all those sorts of things. But at least as to UDAP law, the states can bring their own UDAP actions if they want. And then the in-between case are state chartered depository institutions, state banks. And there the states have an intermediate rule because they're chartering them. They can regulate them, although there's limits on how much they can regulate the interest rates they charge. And they have some role, again, undetermined role in enforcing federal law. Certainly they can, again, enforce state UDAP law. And the question as to how much broader that goes. So that's sort of the scope of their jurisdiction in terms of how the CFPB worked together. As I say, it was certainly at the beginning in particular, I recall the first examinations that were done of payday lenders, for example, were done jointly with states. And that was in part because we didn't know whether the state payday lenders never been subject to federal supervision. It wasn't clear what was going to happen if a federal examiner arrived and knocked on the door, whether the door would be open and how widely. And so we were able to collaborate with states because they were used to having state examiners. And so the examination proceeded jointly. I think that was relatively unusual as the Bureau matured. There were a bunch of enforcement investigations that were done jointly, enforcement cases. There were some cases where actually 48 or 49 states joined with the CFPB in bringing a case, although more commonly it would be one state, two states, often what you think of as blue states, but Florida was a party to some, even Arkansas. So it's not South Carolina. It was not just a red-blue dichotomy.
Yeah, and I can jump in too. So I think like David was describing the dual banking system, which is people love to harp on, I think can get very politicized about this whole idea of like the federal versus the state regulators. And I think we're at this really cool moment where we're seeing depending who you ask, the benefits or the drawbacks of that dual banking system of when you have state charters and federal charters, and then the fintechs that are in this kind of in-between space of having to, until very recently, get state charters and then now starting to be able to get federal charters. You're starting to see kind of the interplay of where the gaps are and where the overlaps are. So to David's point, like at the Bureau, we would fairly commonly work with the state regulators on areas, either if they had found the same thing. So on the Trident matter for redlining, the Bureau worked with 3 different state AG's offices. So you can imagine the coordination of trying to get 3 different state AGs on board with bringing the same action. But each of them had, interestingly, like independently kind of identified fair lending risk on their own, and then all wanted a bite of the pie in terms of getting credit for that when it came time to have an enforcement investigation and then a settlement. So there's this, you hear this discussion about like the level of sophistication of the state regulators, and are they really kind of something to be respected or feared? And I think a lot of them, even before there was this huge move of Bureau talent into the state agencies, you could see the level of sophistication was already kind of improving over there. And now with folks moving into the agencies directly, whether it be the AG's office or the DFI offices, I think that'll keep growing. And the collaboration between state and federal regulators is interesting because the fines are also quite different. If you look at state level fines under a state law, whether it's UDAP or licensing law or what have you, they can often be pretty small. But I think watching the federal fines has inspired a lot of those state regulators to push for bigger numbers. So you're seeing some of the more recent state level actions are bringing in these million and multi-million dollar figure kind of fines, which is a big shift more recently.
Abby, after your tour at the CFPB, you worked on the industry side at companies like City National and Discover. From an industry point of view, what are some of the key differences between complying with 50 plus different state laws versus federal protection laws and regulations?
Yeah, we were just talking about this week about be careful what you ask for. So I think there is this big push for federal kind of level deregulation and the idea that this would make things easier for the industry. And I think anyone who's worked in the fintech space and had to deal with a 50 state license kind of entity would tell you that was incorrect. And I think a lot of compliance shops are feeling that right now. Because if you have one federal regulator, love them or hate them, you know what the expectations are. And then if you have to track 50 plus individual state regulators and their requirements, it's overwhelming. I have managed that regulatory change management process before at a fintech, and trying to keep track of like the weekly updates from every single state. And then the different for fair lending, which is my area of expertise, you have like different protected classes. So if you look at like in California, you have, over a dozen protected classes, which are different than the protected classes in Texas or Florida or what have you. And so keeping all of those requirements separately, like, and maintaining them together, in my mind, takes like a lot more person power and time and effort and sophistication. So I think everyone is kind of reaping the consequences of this deregulation at the federal level and seeing this uptick at the state level.
I mean, it's interesting because, I mean, as you illustrate, it is that very much a case of be careful what you wish for, and the sort of challenges, I mean, the inherent challenges of a dual system, even when it's not as coordinated. But, one of the things, Abby, that you mentioned briefly, and I want to elaborate on, and David, maybe I'll direct this question to you first, but Abby, jump in, is, the CFPB, there's a lot of different ways to think of it, but one of the ways I've tried to think about it is that it was for a lot of years like a very attractive startup in a lot of ways, right? I remember talking to folks who were at the Bureau very early on when it was first getting set up, and they almost described this idea of like sort of pushing on an open door in terms of recruiting and bringing people in, because obviously it's in the wake of the great financial crisis. There's a real strong sort of almost mission-oriented approach to like, how do we fix the financial services industry? How do we regulate it better? How do we protect consumers? So the point being that the CFPB has actually recruited a lot of talent and trained a lot of talent over the last 12, 13 years. And I think, the sense I get, and David, Abby, would love you guys to elaborate on this, is that a lot of that talent is now being sort of dispersed out across the industry. And I don't know that people are thinking about the evolution of consumer protection and fair lending specifically as sort of a talent dispersal issue, but I think that is actually going to affect how things are going to happen moving forward. David, maybe you can start and comment on that. Let's talk about your AI models for a second. They're great until they aren't. Drift, bias, validation, compliance reviews, it adds up fast. FairPlay helps you identify and correct AI blind spots before they become problems. It cuts model validation time by 80% and keeps your decisions profitable and fair, so you can make more money and do more good. Learn more at fairplay.ai.
Sure. First, I certainly agree with the starting premise that the CFPB was able to recruit an incredibly talented staff. It was a combination of a startup and a roll-up at one and the same time, because we were taking over all these authorities that existed, and there was this process of bringing on staff from other agencies as well, but in a very selective basis. We actually had one of our conference rooms in the early days was called the hockey stick conference room because of the notion. I can recall Raj Date saying, when human capital came to him and they showed him the projections that we were going to grow staffing and we're going to grow like this, and all of a sudden go up like a hockey stick. He said, yeah. Everybody who's pitched me for money in my entire career has always showed me that same diagram. But lo and behold, that's what happened, right? Because we had to, where startups can grow at an organic pace, we had to grow. We had certain responsibilities we had to be prepared to assume at a fixed date. So we had to grow at that pace. But we were able to, it was in many ways, I think, what people in my parents' generation would talk about in the 30s with the NLRB and the FDR agencies, where we're young lawyers who wanted to do what good went, and the CFPB had that aura about it. We brought in an incredibly talented pool of folks. My sense, Alex, is that there's been a trickle, not a flood of people leaving so far, and that a lot of people have been holding on in the hope that the agency that the courts will rescue the agency from what is going on. I think that becomes increasingly unlikely, and we're likely to see much more of a flood. The folks I know that have left have gone. There's some who've gone into advocacy organizations like the National Consumer Law Center, Roosevelt Institute. Some have gone to government and are now in regulatory roles or enforcement roles, and some have gone to private law firms, and some have gone to startups like Abby. Some have gone to larger financial institutions and to compliance functions. The economist who was headed our fair lending section is now, I think, the chief fair lending economist at Citi, for example. I assume that they will, as people move into the private sector, they will bring with them a consumer-centric mindset, and it'll be interesting to watch to what extent they're able to change the institutions and to what extent the institutions change them. I think that's there's always some of both, I suspect.
Yeah, it's been interesting. I have had a lot of folks reach out to me who are currently still at the Bureau trying to figure out kind of what comes next for them as someone who left a few years ago. And I think a lot of the Bureau folks, the sense I get is there's a small percentage of us who are interested in kind of going into industry and learning and like building that skill set. But I think the vast majority of folks are at their core public servants. And a lot of them are willing to take that pay cut and go to the state regulator or go to the consumer advocate groups or go to kind of a private litigation shop that would continue kind of being consumer side, so like plaintiff side litigation. So I think we're going to see a lot of those folks, even once they leave the bureau, a lot of them are still going to be doing the kind of consumer advocacy work. And the caliber, to return to that kind of idea, the caliber of the people who founded the bureau, I think you don't appreciate it when you're in the midst of it, like that you don't know what you have until you lose it. But it reminded me, so I was a White House intern back in the day, and it reminded me very much of like working at the White House, where you're just surrounded by people who are at the very top of their field in every way. And you don't realize it until you leave that and you're not surrounded by that anymore. And you have to explain like very basic concepts to other people. And so just the caliber of people who were there and the caliber of the talent hitting the market now is incredible. And just, I'll be so excited to see kind of what that does to shift the state regulatory environment or the kind of private or class action litigation that kind of comes out of this change in the atmosphere we're in.
I kind of suspect that my friends in the private sector bar are hopeful that there'll be a growing public plaintiffs bar and/or state regulators. I'm old enough. I was a union lawyer when the Reagan administration took office, and the management attorneys we knew were just terribly hopeful that we would continue suing because otherwise they might be out of business. It was really a risky time for them.
And Abby, in the absence of a strong, well-staffed CFPB, like, what do you think the states are going to do, like, when it comes to consumer protection? Are there early examples that might be instructive?
So whenever people kind of poo-poo what the state regulators do, my favorite case to reference is poor Wells Fargo got slapped with a $20 million action. And it wasn't even a state action. It was under state law, but it was a private class action for not making mortgage loans to DACA, so Deferred Action for Childhood Arrivals, undocumented immigrants in California. $20 million. So that's not a small amount of money. And that's also a kind of controversial one, right? Especially when we're talking about immigration all the time today. So these states have this immense power to bring these huge fines. More recently, we had Massachusetts. We have the action against Earnest, which is the kind of disparate impact is alive and well, and the fines are still big, multi-million-dollar fines. So I think those are kind of two that I point out to folks, and there are plenty of other examples if you go looking for them. And I think we're going to see more of that as you have the states having learned from the Bureau about how to get these huge fines, and then also the Bureau folks bringing that playbook into the states with them as they go.
Also, New York State Attorney General has brought suit against a couple of earned wage access and direct-to-consumer advance companies under New York state law, claiming that essentially claiming that they're making loans without disclosing them, and I think there's UDAP claims as well. So I mean, there'll certainly be states that are quite that are quite active. It won't be everywhere, but it'll be states with large populations. So if you want to do business in California and New York, that'll certainly be a factor one will have to take into account.
Yeah, I wanted to ask you about that, actually, because one of the things that we know is just going to be true is the industry is not going to stop innovating and coming up with new products and leveraging new technologies, right? I mean, the fintech industry is sort of the force that pulls everyone in the financial services space forward on a lot of those things. And that's going to continue even if the CFPB is sort of defanged for the moment. And I guess the thing I'm curious about, and David, maybe I'll direct this to you first, but Abby, would love for you to jump in, is I'm curious how the states will adapt to that, right? Because I mean, one of the real interesting parts of the CFPB's original structure, and David, you were there at the beginning, so you can talk to this, is a real function on understanding the market and researching the market and understanding like where it's going, what are some of the new things, and I've always kind of gotten the sense that the states over the last dozen years have really leaned on the Bureau's expertise in terms of researching and understanding the space to sort of follow along behind that. I don't think it's unreasonable to expect that work might slow down or in some cases stop in the short term. How do you see states kind of adapting to whatever the newest innovations are that are coming out of fintech?
I think we actually have some precedent already we've seen, and I'm not sure. I agree with you, Alex, that I wouldn't expect the CFPB to be playing a leadership role. The proposed cuts would leave the Office of Research with 3 people, a director and 2 underlings, and the director has since resigned. So I don't know, maybe it's down to 2. So the CFPB. But I think the states actually have already, and were even while the CFPB was quite active. So if you think about earned wage access, for example, one of the new products, the California Department of Financial Protection and Innovation was the first report looking at gathered data from all of the major players in the earned wage access and direct consumer space, and published a report on loan usage patterns, costs, some consumer outcomes, and that was kind of the first report that gave some insight into what that looked like. New York, even before that, had sort of gathered in information and identified a practice of some folks of that if you didn't tip, you wouldn't continue to be eligible for accessing, forced a change in that practice. So I would expect what you see is the states will either assert licensing authority and collect information so that they begin to get insights into practices of newly emerging products, and then kind of make assessments as to how do these products create consumer protection issues that are of concern. Maybe the recent Connecticut law on earned wage access and direct-to-consumer advances may be the best example of what the next stage might look like, where Connecticut, at one point, the state banking department, I think, had opined that these products were covered by Connecticut's small dollar law. The result of that was, and that as a result, they were subject to Connecticut usury laws, and that the fees that were being charged for expedited delivery of funds or tips all counted towards usury cap. The providers of those products ceased offering them in Connecticut, or ceased offering expedited delivery, same-day delivery. And the Connecticut legislature concluded that didn't work, and so they enacted a new law which establishes a set of guardrails around the product, some of which would confirm existing practice, some of which are actually advances that remove incentives to creating artificial caps on how much money you can draw in a single day, for example. Making the default for, if you're soliciting a tip, the default has to be 0. So these are new rules that have been put in place, which I think will make for a fairer market for that product, and feels like a model of what we might expect in the future as new products emerge.
And I would argue the states are very pragmatic. They're very good at doing a lot with a pretty small budget and with staff who have to cover a lot of topics. So they're typically, a state is not going to have a whole big team of people who cover every single consumer financial product. That same team is probably going to be covering like health insurance companies and like all of these other things. So I think they're very pragmatic in that they're trying to sort what is this product? And so I think there's a lot of, in fintech especially, we've all seen it, these companies that are like, we're brand new, no one's seen a product like ours before. And it's just like a payday loan, or it's like a home equity loan or something, right? Like we all see that like day in, day out. So whenever I see one of these fintech products, I'm always trying to get to the bottom of, okay, what is it? Is it cryptocurrency? Is it a personal loan? Is it a HELOC? And I think the way that the states do their licensing, I think, is a reflection of that pragmatism of, you see almost every fintech that's state licensed has these money transmitter licenses. And so they're just trying to get to the bottom of, okay, what is it? Let's sort you into one of these products. And then if it's truly innovative, I think they get caught up. It might take a little bit, but you've been seeing these like kind of pockets of fintech innovation and like very strange and unexpected places. So like Wyoming has become like the cryptocurrency hub. Like who would have like put bets on that, right? So I don't know, it's a little unexpected. I think the states are pragmatic, and I think you'll see these innovative little pockets popping up.
I mean, Abby may be right, but I think trying to fit new products into existing into existing categories creates a lot of risk of under over-regulating or misregulating. And I would hope that states would actually think about these things if, to the extent there are truly new product categories, is earned wage access a loan or not a loan? That feels like not the most important question to ask in deciding how it should be regulated. And if you could think about this as, this is something that has some attributes like a loan and some attributes like a salary an employer letting you get your money early, and what are the consumer protection issues and how do we deal with it? That I would hope, and I think there'll be states that will move in that direction as well.
Yeah, I would agree with that. I think some of them, you'll see like the Californias and New Yorks that have some of the more sophisticated staff that will help move that needle. And then, of course, you have don't sleep on the Conference of State Bank Supervisors. They have been, they are so ahead of the curve. I know a bunch of the folks from Washington who are over there, and Washington's another state that's they're very clued into all the innovation in the fintech space. And so they're sharing all that knowledge among the states that way too.
I agree. Don't sleep on the Conference of State Bank Regulators. Shout out to Brandon Milhorn, friend of FairPlay. David and Abby, the CFPB obviously isn't dead. Dormant is perhaps a better word. If we experience another major political shift in 4 years, do you think the Bureau can be rebuilt? Can it roar back to life? What might that look like?
So I can go first on that. I'm not real sanguine about that, Kareem. To begin with, we know that the reconciliation law, the big brutal bill or big beautiful bill, take your pick, cut the cap, the CFPB's funding max ceiling in half, so that at best it can roar back to a half-life. But you're losing a huge amount of people, but expertise, leadership, and infrastructure, and those are hard things to recreate. Well, Alex was said, in startup days, first there was an aura around the CFPB, which would be hard to recreate. There were also a set of rules that made it easier to hire than it is in standard government. We were able to move contracts. We got things through paper approvals to do things under the Paperwork Reduction Act in days that would typically take months or years. So I think between the funding limitations, will there be an willingness to people to come back knowing what's happened at CFPB? So, I don't know. On the other hand, the other thing I would say is I think one of the things we've learned over the past 6 months is that a relatively small number of people, if they are highly motivated and committed, can make a lot happen in government in a short period of time. Now, it's easier to disband, shut, and destroy than it is to build up. But could even if the CFPB can't come back to anything like what it was, could a skeletal crew of really committed people do some really useful, constructive, important things relatively quickly that would affect the industry? Yeah, I think that's possible. I don't think you need to get back to or can get back to present levels to still have an impact on the industry.
I totally agree with that. I guess I'll disagree. I agree it could be you could have a small group of dedicated people. I'll disagree in that I think it could be rebuilt so quickly that I think you could pull people back in. Even people took huge pay cuts to come to the Bureau the first time around. People who left industry went from being law firm partners, making, we all know what law firm partners make, to making a federal bureaucrat salary. So even though it was pretty big for federal government, people took massive pay cuts to be there, and I think they would do it again. And I don't know, I think it would happen so quickly. And the whole ethos of the Bureau was this tech startup type culture. So they brought in all of the kind of processes from tech. So if you walked around the Bureau and you looked at even the rulemaking teams or enforcement teams, they were leveraging all of these Six Sigma, all of the kind of tech industry kind of practices for developing and implementing on processes. So I don't know. I have great faith that it could be stood up. It was 18 months to stand up a new federal agency. And so I think it could come right back roaring to life.
Yeah, it's interesting. It kind of feels like one of those things where something has irrevocably changed a bit. And I do think the point you guys were making about just the diffusion of challenges and approaches and strategies for dealing with this stuff, the states have really leveled up their game. I think that's a pretty fair thing to say. I think, Abby, to your earlier point about the private litigation and that sort of spreading out to like law firms and stuff, that's a point that's really well made as well. So I think, the environment is more decentralized and has changed in important ways, but also things could roar back in various ways 4 years from now when the politics of all this change. Abby, I want to direct this question back to you to start with. What exactly could we expect in terms of like statute of limitations and like the ability for a different CFPB 4 years from now to go back and look at some of the stuff that's happened over the last 4 years? Like when you talk to folks in the ecosystem about like how to approach this next 4 years, how do you caution them on that?
Totally. Yeah. And you'll hear this among the compliance folks kind of pretty regularly to like beware the look back period. So I think of like for a COA, it's a 5-year look back. I think that's a pretty common kind of time period to plan for a look back period. And that was common. Any of the enforcement investigations I worked on, we would look back actually further than that to identify risk, but you can only bring the action under that period. So we would do a look back, like, I don't know, up to 10 years running to see how did you have risk and how did it change? How did it ebb and flow over time? Because we wouldn't want to, enforcement actions are very resource heavy. And so you don't want to spend all this time spinning up an action if it's just like a 1 year problem, versus if they've been if an institution has been doing the same thing for 5 or 10 years.
So David and Abby, we're wrapping up. What advice would you give to a financial institution on how to navigate consumer protection questions in the current environment? David, why don't you go first?
I guess so. The first piece of advice I give is to apply what I think of as the grandmother test. If you're doing something that if it happened to your grandmother, you wouldn't want that to happen, you shouldn't be doing it. So there's a sort of a sub about that. I mean, I think some of what the Bureau did was just to elevate to the attention of decision makers things that their institutions were doing that they didn't even know they were doing. So continue to take consumer complaints seriously and escalate them and look at them because they are a window into things that are happening that you may not want to be happening. So I'd start there. And then I certainly agree with the point Abby was making earlier that don't assume that somehow what's happening to the CFPB means there's a free pass. There is a look back period. There is the potential of private litigation. There's the potential of state litigation, so that you shouldn't be sort of assuming that somehow you're now the legal world has changed. And I guess the third thing I would say is institutions that had made a commitment in the wake of George Floyd and to re-examine practices and the impact of their practices on different groups of people and to try and achieve more equity in the world. That shouldn't change and doesn't have to change just because there's a change in the administration and what its legal expectations are. And I would encourage institutions, to do that as a matter of maybe self-interest and maybe social justice, but some combination of that.
And I'm a little bit more pragmatic. I'm always trying to be the pragmatist here of having worked in-house for a couple of years now. Anytime I'm talking to bankers, I have to talk numbers to them or they kind of tune out, right? Like a banker wants to hear, how is this making me money is kind of most of my experience. And so just realistically, if there's this push, if we're in the look back period, if there's a change in the administration down the line, we're going to be held accountable for what we're doing right now. And if you're spending all this time like chopping up your compliance team and kind of reducing your compliance efforts, that is going to come and bite you later. And it's going to be really expensive to be staffing up your compliance team again when everyone else is staffing up their compliance team again in a couple of years. So just as a matter of practical kind of continuity and thinking ahead to what kind of fines you could be looking at in the future if you do kind of follow this path of deregulation, I think the long-term losses are potentially a lot higher than the short-term gains you may get from not paying attention for the next few years. So I would say don't take your foot off the gas. I think it's just like best practice. A lot of these compliance thresholds are there because they are good for sound business. Like a lot of them are there for a reason. Like you want an AML program so that you don't have people coming in and like taking money away from the bank going someplace you don't want it to go. You have fraud protections to make sure your bank isn't losing money. Usually a fair lending issue is a sign of a bigger problem. So these compliance positions, most of them, not all of them, are there for a reason and kind of serve a real business purpose is what I'd argue. And so now is the time to just kind of stay the course, keep doing what you've been doing, and then be ready when things change down the road again, because they always do.
Yeah, I mean, I think that's really well said. And just to kind of put a further point of emphasis on that, and then Kareem, maybe I'll come to you for a little bit of your advice on this topic, since this is the world you live in too, and would love to have you close this out for us. But I think that's really well said, just in the sense that a lot of this is also good business, right? And that's one of the number one things that I've been hearing from a lot of folks in the ecosystem as they've been trying to navigate this sort of change in administration and change in the regulatory environment, is a lot of the stuff that was sort of very much in favor from a regulatory perspective and maybe now is a little bit out of favor. That might not be the right lens to look through it. The right lens to look through it might just be like, do we think this is good business? Like, do we make money doing this? Is this sort of positively accrete to our brand and the reputation and the trust we want to build with customers? And if the answer was yes a year ago or 2 years ago or 4 years ago, it's probably still yes today. And so I think steady as she goes is a really good general point of view. Kareem, I'll give you the last words on this topic before we wrap up.
Yeah, well, I think, David and Abby put it very well. But at the end of the day, in our world of fair lending, if your decisioning process is systematically including some population that would have paid you back, that's not just a fairness issue. That's kind of an underwriting quality issue. And so in our view, done correctly, fair lending in particular is the kind of practice that should allow you to make more money and do more good. It turns out that a lot of our underwriting systems are sort of overfit to majority and easy to score populations. But we know that something like 50 to 60 million Americans, many of them, I might add, are supporters of the current president, may not be well served by some of the legacy underwriting tools and infrastructure. And AI and alternative data provide a much better opportunity to paint a finer portrait of someone's ability and willingness to repay a loan. And so done correctly, we believe that fair lending practices can be good for profits, good for people, and good for progress.
Absolutely. And I'm glad you mentioned AI, because for listeners of this series, this is the first in a series of conversations we're going to be having where we're going to delve into a lot of different areas where AI is sort of changing how financial services companies operate, how they make money, how they comply with changing regulations. So we'll be getting into that in a lot more detail in coming episodes. But for the moment, David, Abby, thank you so much for joining us. I learned a lot from this discussion.
Thank you.
Thanks for having us.
If you're struggling to get AI models into production fast and without compliance headaches, FairPlay can help. FairPlay helps financial firms build, test, optimize, and validate their AI models. FairPlay identifies and corrects AI blind spots, makes model validation painless, and scales governance without slowing you down. The result? Higher ROI, faster time to value, and reduced regulatory and reputational risk. Smarter AI, better decisions, more value. Learn more at fairplay.ai.